Hi everyone, it's Trisha Ghosh. I am a mortgage banker and this is Trisha Talks Mortgage. So today we want to talk about interest rates. That's the number one hot button issue with all of my borrowers is what's your interest rate, right? So interest rates really matter because your monthly payment is based on your interest rate. So the higher your interest rate, the higher your monthly payment's going to be, and the more that you're going to pay overall on your loan over the life of that loan. So obviously everybody wants the lowest interest rate possible, right? But how do you get that lowest interest rate? And what does that mean for your buying power? So obviously, the lower your interest rate, the lower your monthly payment. So the more buying power you have, the more home you can afford. You can go a little bit higher in purchase price when your interest rate is a little bit lower and have the same monthly payment. Because at the end of the day, we determine how much you qualify for based on your debt to income ratio, which a big part of that is your monthly payment on the new home that you're going to be purchasing. So looking at this chart, if you have a 5.5% interest rate at a $300,000 loan, that's just over $1,700 in payment. Contrary to that, if you jump up to 7.5%, just that 2% difference, now your monthly payment is almost $2,100. So that's about a $400 difference, which is a big difference, right? So interest rate does make a big difference in affordability and in just what you're going to be able to have as your monthly payments. The number one question that I get asked is, what's your interest rate? And I never answer that question right away like that because it depends. It depends on your credit score, your loan to value ratio, your loan program, your occupancy type, your property type, your blah, 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 all these different factors, right? Interest rates by and far are risk based. So you want to try to reduce the risk of foreclosing on the loan as much as possible. How do you do that? Well, it's through these different factors. You want to make sure you have the highest credit score possible. The higher your rate, the more likely you are to repay your bills. That's just kind of how credit scores work. Loan to value ratio is another big issue here. So the more down payment you have put down, the more skin in the game you have. You have investment, you have money tied up into a property. You're not going to just walk away from that and not pay your bills anymore, right? You're going to do what you can to make sure that you hold on to that investment. So if you're only put down a small amount, the risk of you leaving that or getting foreclosed on is a little higher. The loan programs make a difference. The different investors that back those particular loans, whether that's a conventional loan, a government loan, or a jumbo loan, that's who's going to help determine those interest rates. And each of those loans have different risk factors as well. Occupancy type, this is a huge one because if you have a primary residence and a second a vacation home, right? Which one are you going to pay the bill on if you're running short on money? Your primary residence, right? You want to be able to make sure you still have a roof over your head. So your risk is higher on a secondary home or an investment property. That's why the interest rates are going to be a little bit higher on those investment properties or second homes. The property location matters too. Believe it or not, there are some geographic risk-based adjustments that are made for different states and different areas. It's just kind of how it works. And then the lock period too. So typically whenever you lock in an interest rate, you lock it for a certain amount of days. That may be 30, 45, 60, 90, even up to 360 days. Some lenders have some extended rate locks. And the risk of the interest rates changing in that amount of time differs. So the shorter the rate lock, the lower the cost for that rate is going to be. Rates are not one size fits all by any means. And you can definitely improve your interest rate by improving your risk factors. So make sure you understand what your risk factors are. Talk to a loan officer about how to lower those risk factors and get the best interest rate. This has been Trisha Ghosh of Trisha Talks Mortgage.